Hello and welcome to this week's market special from Business Today. I'm Udayan Mukherjee, with me is Abha Bakaya, and our guest on the show today, Sanjay Dutt of Quantum Securities. Sanjay, good to speak to you after a long time. I mean, you're sitting at the epicenter of where the problem is. In India, everybody agrees we are not in such a bad place. But where you are today in New York, that's where the real mayhem is going on. How much longer do you think it will take for the US to sort itself out, so we can get along with what was looking like a good enough economic trajectory for us back home in India? But the US is in the way. How long do you think it will need to deal with its own mess?
Thank you for having me over, Udayan Abha. Coming to your question, Udayan, I think US is in a very complicated position this time, and there are no easy solutions that are possible. I think time is the only thing that will sort out things. There isn't much which the policymakers or the central banker, the US Fed, Jerome Powell, can do much right now because you know this time it's a bit too complex given the fact that you've got these geopolitical problems, you've got a breakdown of the global economic order uh, because of trade coming to a standstill for various reasons, whether the Ukraine war or before that the COVID, etc. So it's not just about inflation; it's about a lot of other things that have played out, and it's going to be very difficult for US to handle. And I think it's going to take time, probably a year or so, maybe more even, because there are some structural issues which have been kicked down the can. The can has been kicked down the road, and now it's like the cows are coming home. So US is not going to be able to sort out much in the near future. To cut a long story short, we need to figure out as to how the rest of the world deals with it.
Right. So they say the markets factor in all these things a bit ahead of the economic outcome. But you just said that it will take another year to fix the problems. But we've been in this bear market for the last 7, 8 months already. The prices started falling way before the bad news hit the headlines. So, how much longer do you see this bear market continuing now? How much is in the price? And would you say there is 6 months of pain left, 1 year of pain left to go before we can start talking about another uptrend once again?
You know, uh, First, to be very clear upfront, it's very difficult to do crystal ball gazing right now, even when it comes to India, where one understands things a lot better than one understands in the US or the Europe. I think our problems in India have got to do a lot with what's happening globally, and more so what's happening with regard to the Ukraine war, oil prices, global trade, those kind of issues, and then obviously linked to that are flows. Uh, my sense to try and come to a guesstimate on the figure that you asked, how many months more, or how many, what is in the price? I think about 60 or 70% of this negativity, the uncertain economic environment, the uncertain micro and macro issues, 60 or 70% of them already are in the price. And that's clearly reflected in a large number of pockets across the market, specific equity stocks, which have really been hammered down 50, 60%. But I think there are a few months of pain left, which I think would probably go on till about October or so. That's on the basic assumption being that we have some solution on the Ukraine war because Europe cannot live with these energy prices and these energy issues across the winter. So that's my basic thesis that the Ukraine issue would sort out. If that sorts out, I think we might be better off with oil cooling down. A lot of outflows that we're seeing right now would be sorted out. We would have a decent monsoon. I think with these kind of things, these kind of assumptions in place, I would say by about September or October, we should be done with the worst or probably this grinding phase of the market. We may now go into a consolidation, a time correction more than a price correction over the next few months. And that obviously will be painful, but that should end in October, I think.
what about the price damage itself? How much is left, you would say, Sanjay? Because while you said many stocks have corrected 40-50%, bulk of the selling has come in from foreigners. We haven't seen any great sense of capitulation from local investors. Do you think that shoe will fall before this market bottoms out?
I'm glad you made this great point because a whole, thesis of, applaud on the floor of the parliament and otherwise the retail investors have kind of, held on this time and a pillar of the economy, blah, 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 pillar of the markets, blah, blah. I think that shoe will drop and we're already seeing first signs of it. I'm seeing it at my retail desk where we've seen quite a few of people starting to panic and get worried. And as soon as we start seeing some domestic outflows from mutual funds or SIPs slowing down or whatever, that's where one will get clear indication that the real capitulation from the retail end is coming in. But anything is possible if retail does not capitulate or more money starts flowing in. Then I would really say that the India structural story in terms of flows, in terms of ability to bat against the FIs has turned. But I doubt that because retail has to capitulate, retail has to get worried and panicky, and that's where we'll probably have a bottom in place, in a few days' time or a few months' time once that phase begins.
Sanjay, you've always been so selective about finding those value plays in the market. At a time like this, what would you advise getting into? Until a short while ago, of course, we were discussing banks. Does that still hold merit, and why?
Yeah, Abha, I think I find banks a good place, and more so some decent PSU banks, like a Baroda or a Canara or a State Bank. Of course, disclaimer that I might own some of them and I'm biased. The reason being that most of these are not overowned or not owned at all by the FIs or institutional players, but are at compelling valuations with much cleaner balance sheets compared to what we were post GFC in 2008, 2009, or where we were in 2012, 14. And also on ground, I'm seeing that lending practices that were followed in our first 10 or 15 years when I started business, that's from 95 to 2010, are not being followed anywhere. Way much cleaner, way much stricter diligence processes, even in the PSU banks. So that's what makes me a little positive on them. And I think the big story, once we have the market sorted out, are going to be good quality PSU banks ahead. Yes, we've had likes of HDFC Limited also not performing. The HDFC Bank merger is also a good development. So that would be a good place to really keep nibbling on as things decline. Because if you believe in the India trade, manufacturing, and the global China plus one or whatever you may throw at common audience, if you believe in that kind of a PLI and all those things, the biggest beneficiary of that has to be banks because you ultimately need working capital and term financing.
Speaking of PSUs, Sanjay, the one which has really left a bad taste in the mouth for investors over the last few weeks has been LIC. I mean, such a lot of retail money went into that and it's just gone one way, which is down. Is enough now, or do you see the stock continue to remain a bit of a laggard?
I think it would be an underperformer over there because unfortunately, the way that stock had been sold, the way it was marketed to the investors, as you can clearly make out from the subscription pattern, the way the policyholder portion got subscribed way above any of the normal institutional HNI or other portions. So it was very obvious that the stock was literally pushed to get the issue subscribed. And I think that supply needs to be absorbed. That supply would be absorbed in this, minus 20, 25% range or at par range of the issue price. Once that supply is absorbed, then it'll probably be a good bet. Because definitely, insurance is a great bet. But would I buy LIC? Maybe not. Maybe if it gets 10, 20% cheaper, probably for a renter ride, probably for a trade. But I think there's more pain there because the way it's been distributed is unfortunate. But I guess there were no options. It had to be done the way it was.
You know, the other part of the market, Sanjay, which is quite well owned now and which has been hurting for the last many weeks is mid-cap IT. You know, all these stocks had done so well last year, all the Mindtrees and L&T Technology and Coforge, Happiest Minds, these kind of names, and they're all down 30-40% from their peaks, which is leading to a lot of heartburn. What would you advocate to investors who are holding on to these names now in the midst of this current global volatility?
I think the biggest problem we're dealing with these stocks, one, they're overowned. Second, I think execution and number delivery challenge will come for the managements, because the way the global markets, particularly their customers that are now going through what they're going through across Europe, US, and other geographies, is going to be a little difficult for these mid-tier companies to be able to maintain margins. And a phenomenal amount of cost pressures being seen by them, mainly coming from good talent, because good talent is turned so expensive in the last 2 or 3 years that the biggest effect of that would be seen in the mid-tier IT companies. So to cutting a long story short, my advice would be is to probably get out of them and come into the top tier ones like the Infosys. If you need to have exposure to the IT sector, you would be better off in the Infosys, Wipros, and those of the world than being stuck here. One, because a lot of distribution has taken place, overowned amongst retail, and I don't see large institutional money coming in them because, of course, you have a problem about the market cap and deal size. And then also the leader takes it all in these times, particularly in difficult times. So therefore, the Infosys and the Wipros and the TCS would be the first ones who would adjust to the new reality. So to conclude, I think one would be better off in moving out of these stocks and coming into the top 5-8 names if you wish to have IT in your portfolio.
Right. What about cement, Sanjay? That's a huge talking point right now with capex being planned across some of the big companies. Is that a play that you would look at?
Yeah, I like cement. I think cement is a very good sector ahead. Yes, the landscape has got competitive with some of the big boys coming in now. I think there will be more consolidation. So to conclude, I think stick to the top 3-5 players. Top 3, in fact, I wouldn't say 5 players. I would say stick to the top 3 players. There is money to be made. I would at this point of time back the Birla Group. So I think that's one place to be. I don't have an investment there as a disclosure, but I've been looking at it, and I think there is money to be made in them long term. Of course, there's going to be capex, so there's going to be time for them to really be able to deliver much superior earnings going ahead. But that's one group I would like to be, both in a stock like Grasim as well as their cement venture, which of course you can play them indirectly, directly, both ways.
Sure.
But the commodity which has got hit very brutally, Sanjay, is metals. I mean, at the start of the year, everybody was talking about a commodity super cycle in steel and aluminium. And you see the way Tata Steel and Hindalco have collapsed 40-50% from their 52-week highs. Is that super cycle dead now with recession talk, or do you see these as good entry opportunities in many of these frontline metal names?
I'm glad you asked me this question, Udayan, because you've known me for close to 3 decades now, 2.5 decades, and you know my style. My style has normally been contrarian, where I step out and look at something that's no one wants to look at, but it's still got growth prospects ahead, maybe next 6-12 months of pain, but that's where I normally tend to pick up stuff. And today in the market, I did take some positions in some of the metal names. Places like Hindustan Copper, Nalco, Vedanta, Tisco. I think it's time to level into them. I wouldn't call it a super cycle because that's what then kind of has jinxed this whole thing, and then retail starts kind of getting into an overload position, and then we have this typical derivative exposures in which it's cleaned out. But frankly, business is looking good for these companies. They may not be in a super cycle, but they'll definitely have way better margins than they've had over a, say, 10 or 12-year period starting from 2009 onwards till 2020. And the good part about that is both the demand side is good for them in the next 5 years. And I think the biggest benefit there is that debt is off balance sheet. So most of them have got manageable debt or optimum debt or zero debt, quite a few of them. So that's the reason I want to invest in them, because I think demand destruction for metals is not going to be there really. Next 5 years are looking good for the sector, and balance sheets as well as OPEX operation have tightened very well for the last 5 years. So the margins would be maintained, may not be as good as what you saw them in the last few quarters, but there is money to be made now that they are down 30 to 50% from their highs.
So far, the narrative, Sanjay, has been that this is a Western world problem and India is actually in a good place, but we got hit or our trajectory got derailed because of the problems of the West. Now, what if this is not, we find out after 3 months that this is not just a technical problem of FII selling, etc., but we actually also have an earnings problem on our hands. The assumption that earnings will have refound their mojo and will now grow at 20% plus is being challenged, and we are seeing a rafter of downgrades month after month. Do you see that core earnings problem in India, or do you think we will escape that this time?
No, then I don't think we'll escape it. That's the reason why I said that we would have to live through this pain till October, November, because I think the next few quarters and maybe this whole FY23 would be a challenge. Once we reach October, November, we would start working on estimates for FY24. In fact, I was reading the other day, a friend of mine had tweeted that Nifty is at a compelling historic price earning multiple, and he was turning out some estimates of 900 or 1,000 for the, 9,900 plus for Nifty. That's 900 earning per share for Nifty. So basically he came out with some logic that, it's compelling and it has to go back to that same 20s we normally have Nifty trading in. My argument was that if that E itself is questionable and will not be achieved, we'll have to really downgrade aggressively. Then the whole issue of historic P becomes irrelevant, because first you have to get the E correct. And yes, I think we have a problem there. What we are seeing right now is not really a global problem, and India will come out with, bright colors shining over the next few months. I don't think so. Earning estimates would have to be taken down. So therefore, we'll have to live with this pain of a sideways movement. But that's the reason why we've had such aggressive price correction also in many of the stocks, because the fund managers and smart money are figuring out that it's going to be earnings damage also. So it's only down in October, November would one have more clarity on some of the things play out, as I mentioned, that's Ukraine, etc. Then one would get better picture as to where we're headed. It's definitely going to be an earning problem for India, to really cut a long story short. Yeah.
Sanjay, what would be your advice to a retail investor or someone relatively new to this market who's only been enjoying the highs so far? As a veteran and somebody who's seen various cycles, what strategy would you leave them with?
Oh, welcome to reality. Markets are painful. There's no easy solution of making money in the markets. You literally have to sit down one evening and cry, literally be in tears over your portfolio to be able to make big money. Because, it's not a smooth one-way ride as what they've seen post-March 2020. They'll have to live through a lot of pain, probably lose a lot of savings, and learn it the hard way. The only way that you got to make money in this market is go down and see earnings, read balance sheets, hear conference calls, understand where you invested. Don't be in a Me Too situation of buying some stock and because, so-and-so big investors got this stock, so therefore I need to be in. That's no way are you going to make money. You need to do your work. That's the lesson. Anyone who's come into the market in the last 2 to 3 years, you got to be in high conviction stories, and you have to understand why you're holding an Infosys or a Reliance or a Adani or whatever you may have in your portfolio. I know of 70 or 80% of retail investors who've come in the last 2 years don't even have a clue of what the company does, and they have it in their portfolio. So, that will change and has to change. I think the process has already begun.
All right, Sanjay, thanks so much for joining us today. Always a pleasure, and we look forward to speaking with you again soon.
Thank you, Ava. Thank you for having me. Thank you, Udayan.
वीडियो पसंद आया तो हमें लाइक, कमेंट, शेयर और सब्सक्राइब जरूर करें।